Hey everybody, back with another dividend analysis, and today we're going to be looking at Dow Inc, or very simply Dow. Wanted to take a peek at Dow because the recent corporate history is very interesting, which makes analyzing the dividend a little bit trickier, and a good challenge in analysis never hurt anybody. So without further ado, let's start with the dividend yield, currently sitting at just over 5%. So you'll be doing about 3 times, maybe a little bit over 3 times what you're getting from the S&P 500, which Dow is a member of, as well as the Dow Industrial 30. So a very large, very mature company, and you're getting a nice 5% yield. So that's nothing too bad there. Looking at the dividend history, we can see that about 8 years ago, we would have been getting 32 cents a share, and we are currently getting 70 cents a share, so better than double in the last 8 years. Now, if you do look here, you can see that 2018 and part of 2017 and 2019 are missing. That is not a mistake. Dow merged with DuPont in 2017 and then was spun off from Dow DuPont in 2019. So they were merged with the other largest chemical company in the country for about a year and a half to 2 years. That's why this is missing. And we can see that before the merger, they were sitting at 46 cents a share in dividends, afterwards 70 cents a share, and since they were spun off in 2019, we have not had a dividend increase. So since the company has been a sole entity as it is right now, there has not been a dividend increase, but there was when it was before the merger. So just keep that in mind. There really hasn't been any dividend growth since the company became its own sole company again. Just something to keep in mind. Let's move over and see if they can actually afford to pay that 70 cents a share dividend. As usual, we'll start with the free cash flow. Looking at the cash flow growth, of course, because they were part of another company in 2017 and 2018, part of 2019 as well, the cash flow doesn't give us all of the years, but we do have 3 years to look at here, and we can see there is some very good cash flow growth, going from 2 to 4 to $5 billion over 3 years. Not too bad. They paid out about $2 billion in dividends in the last 12 months, and looking at this number, which is from 2020, not 2021, their full year financials are not out yet, so keep that in mind. But from $5 billion, they would have paid out about 40% of that free cash flow in dividends, well below our 50% ideal range. No real danger of that dividend being cut because of cash flow problems. Moving over to income, let's see if they're able to afford it in that way. We do have income from the previous years, which is nice, and as we can see, our income in the last year was about $1.22 billion, which was not enough to cover the dividends, so they've had to pay out some of the cash that they were sitting on to pay for that dividend. We're not able to afford it in terms of just income. We can see there was a very large loss, almost $2 billion the previous year, while the year before that they did over $2 billion and were able to afford the dividend. Just very uneven cash. So we can see we go from $4 billion down to $500 million, down to up to almost $3 billion, down to a loss of $2 billion. It's just very all over the place. If I was looking at this would be a little bit concerning. We have that free cash flow increasing year over year for the past 3 years, but every year has been up and down for the last 5 in terms of income. I would really want to see that normalize, because those numbers really should even out over time to be about the same. There'll be some variance between your income and your free cash flow, but this much variance is just something really interesting. I'd really want to delve in to see, write-offs, depreciation, everything, see why this income is so spotty, so all over the place. So keep that in mind if you are looking at this. Now, what does Dow do? Pretty much everybody knows, even if they aren't completely aware of it. Dow does make chemicals. Their biggest things are plastics, coatings, chemicals in general. They are one of the 2 largest chemical makers in the company, along with DuPont, who they were merged with for about a year and a half to 2 years. You probably have some Dow products around your house somewhere. You see them every day, stuff like that. Very large company, member of the S&P 500, member of the Dow Industrials. It is a very large, very mature company. This isn't something that's going to go out of business overnight. This is really going to be something that's either there's a competitor that pops up and drops them, and over a period of decades, there's mismanagement, there's something like that. On the flip side, when it comes to growth, there's probably not going to be a ton of growth here because of how just mature the company is. You're looking at things like inflation, GDP, stuff like that. If they have some amazing new product that comes out that really just puts them, gives them a nice strategic place in the market to get growth that way. Otherwise, you're really going to be looking at that dividend. Now, looking at it, should you be looking at it? Is this something for you? From the appreciation side, as we saw, over the long term, yes, we've gone up by almost, over 100% in terms of dividend, but we haven't really increased since 2019 when the company spun off again. So it seems like dividend appreciation isn't really the way they're looking to give back to their shareholders in terms of, giving back to them. I would be looking at seeing if they're doing things like paying down debt, seeing if they're doing things like buying back shares, because they were only using about 40% of that free cash flow to pay out the dividend, which means they have plenty of room. 40% is a good number, don't get me wrong, but you really want to make sure they're doing other things to reward you as a shareholder. Are they paying down that debt, as I said? Are they buying up shares? Are they doing something to, innovate in the business to help that capital appreciation? Or are they going to plan to increase that dividend in the future? All very important to look at if you're thinking about this company. Now, in terms of yield, 5% is very nice. Such a large, mature company. This isn't your 1% from Apple or Microsoft or something like that. It's not something like 8 or 9% from your Altria, but 5% for such a large, established company is nothing terrible. If after 20 years they're still paying their dividend, you would have made your money back in that time, even if the stock had dropped to only a couple dollars and they were still paying that same yield. So just keep that in mind. There's a lot of yield here. This is gonna show up in a lot of dividend ETFs just because of the yield and because of how large the company is. It's what some people would consider a very safe yield. It's very unlikely that this will be cut unless the company goes into some very, very tough times. That income's something to look at. But yes, overall, it's pretty interesting with them having been a company, merging with a company, and then being spun off from that company, all within a period of about 2 years, is very interesting. It is something to look at. This is definitely something where I'd go into a big, deep dive onto it to make sure that yield, since it hasn't increased and since they spun off, stuff like that, I really want to be sure that yield is safe, seeing that income is going to normalize with that free cash flow, stuff like that. And as always, thanks for watching, and I will see you next time.